Are you expecting that regional underperformance that we've seen in the first half sort of reverse? And who will be the biggest winners?
Well, we think that the markets will reverse in favor of Asia, largely because, in the first half of the year, the US dollar has actually been particularly strong. In the second half of the year, we do expect the rates to actually peak and therefore thereafter for the dollar to actually weaken against most of the G4 currencies. And that in turn should actually drive the outperformance of Asia ex-Japan markets, given the fact that the inverse correlation between Asia ex-Japan and the dollar has been very, very tight over the last decade or so.
When it comes to emerging markets in Asia, when are you expecting that consumption boom to make a comeback?
Well, Asia has the benefit of having lower inflation than the European Union or the US markets. And as a result of that, interest rates in Asia does not have to trend higher or as high as what we have in the US and the EU. So for that matter, we do think that with the central banks likely to actually start cutting interest rates in the third and fourth quarter of this year, we do think that Asia actually has a slight edge with regards to consumption because of the fact that, with rates likely to actually trend lower, disposable income is likely to actually start rising on the part of the Asian consumers.
Kelvin, how are you feeling about the broader outlook when it comes to China and having any kind of direct or indirect exposure? Does it sort of hinge on whether we get more meaningful stimulus moves from the government?
Yeah, I think the Chinese market is likely to be pretty range-bound for the time being, given the fact that we actually do not expect the Chinese government to actually unleash any bazooka-like kind of stimulus on a short-term basis. Because despite the fact that the economy has actually slowed down over the last couple of months, the Chinese economy is still on track to actually project growth above 5% this year. So the slowdown is something that is actually holding back sentiment. And we do think that unless we get the property market out of the way, unless we get unemployment rates coming off again, consumption is actually going to be quite weak. The overall prognosis for China is that we think that it's actually bottom up where the economy and the markets are concerned, but it lacks a certain catalyst to actually spark it over again. But then again, if you look at the valuations are really, really attractive at this point in time. And the first quarter results season for the Chinese market has actually been quite good in our view.
And China is actually one of the markets where you're looking for perhaps cheaper exposure to AI, where valuation revenue expectations haven't reached the levels that we've seen with some of the other darlings.
Yes, absolutely. The Chinese market is actually cheap, and it's not just the AI stocks that are actually cheap. I think the whole market is actually trading at well below historical valuations there, and it's actually trading at a 35% discount to the US equity markets. So on that matter, yes, the Chinese markets are cheap. But then again, you don't buy markets, you don't invest in markets just because they're cheap, right? We do think that China on a 6 to 12 months basis looks very attractive. This is probably a good time to actually get into the Chinese market. But at the same time, you have to be patient because it lacks a certain catalyst at this point in time. And that catalyst is only going to come once the unemployment rate actually comes off. People are more confident in their job prospects. That will actually spark some spending where their savings are concerned.